So I think there's kind of two sides of it. There's what he's saying, and then there's kind of the underlying surface of it. So I think what he's saying is correct. That basically it's not just about rates, it's also about the rate of money creation. And if banks are liquidity constrained, if they're risk off, they're less likely to make loans, and that actually slows the economy. So I think on that front, he's correct. I think a subtext there is that because of how quickly they raised rates and how much damage they did to the banking system, basically they ended up raising rates faster than most of us thought they would in an effort to try to control inflation faster than, they basically made that their whole priority. They've created this financial instability, and now they're kind of in a situation where they have trouble raising rates as quickly as they have been, even if they wanted to, without causing more issues. And so I think that they're both trying to justify why they're going to slow down their rate hikes, and then kind of just setting expectations around the fact that they can't really do it. Because if you look at this, if you look at the 1940s, when they were trying to come off the zero bound, right? So there's all this debt in the system, they were on the zero bound, and the question is, how do you get off of that? Because it's very, very hard to do. We've had 40 years of lower highs and lower lows in terms of interest rates, and now they're trying to break that pattern. And what they showed in the 1940s is they had to be gradual with it. Because if they went too quickly, we're kind of seeing today what happens if you do it too quickly. And I think these past months have shown somewhat of a ceiling on how quickly they can do it. And so I think now they're forced to go a little slower, a little bit more measured, and then they now have to justify that narrative and see if that thesis plays out that credit contraction is enough to offset inflation. So I think that they don't want to surprise markets. So I think if they were going to raise rates, they would start hinting at it ahead of time and set markets up for that potential hike. So I generally try not to predict 25 basis point moves. I think we've already gone higher than I would have expected, for example, if you asked me a year ago.
Okay.
And so it's possible they'll go a little bit higher, but I think right now they're going to be more data dependent, and they're going to try to balance between financial stability and inflation, whereas the past year they've been 100% focused on inflation. I think the last hike they did made sense because they still wanted to reserve their credibility. They wanted to have the view that they're not stopping because of the banks. But now that they got that hike in, now they have more flexibility from a public perception standpoint to pause if they want to. We'll see if they take that approach, but I think they probably will. I think we have to separate the idea of a pause and a pivot.
Right, yeah.
I think he's trying to turn off the market's idea that he's going to have a sharp pivot or that he's going to be easy to pivot. I think he's going to basically, to the extent that he does pivot, it would only be due to pretty severe economic contraction at that point. I think the potential error here is that he's treating this like a 1970s environment. So, for example, he's referring to controlling credit as a key way of getting inflation under control. And yet, during this inflationary cycle, it was not excessive credit creation that caused the inflation. So in the 1970s, a big factor that led to that inflation, most of the money creation that was happening in the 70s was very large amounts of credit. And that's because you had the baby boomers entering their home buying years. And so you had all this excess credit creation at a time when there were real world constraints like oil and stuff like that. One thing that the 1940s and the 2020s share in common is that you had very inflationary environments, but it was not because of excessive credit creation. It was because of large monetized fiscal deficits. So I think that from the Fed's perspective, they're encountering this, they encountered this inflationary wave, which was very fiscal driven given the environment. Right. And they don't have tools to counteract a fiscal driven inflation. So they're using the tools that they have available, which are primarily about credit control, even though credit is not what caused inflation. So it's almost like they're trying to suppress credit enough that it can maybe offset what's happening in fiscal. But I think the longer term question of what's going to control inflation will be changes in fiscal spending. And I think that there's maybe too much market focus on what Powell's going to do and not enough focus on what's going to happen in the fiscal environment. I think it would start to get contagious. It would certainly reduce their expectations of how much they can raise rates. I mean, if this was a one-off bank race, if this was like one weird bank, that wouldn't really affect their overall rate tightening. We've already seen a number of banks fail, very large ones. And if you were to have another round of bank failures, especially sizable ones, I do think that would start to quickly affect not just the possibility of a pause, but that would actually open the possibility of a pivot, I think, especially if you had that combined with economic contraction data. I think that basically they can't let financial instability get completely out of control. They're able to have these kind of controlled bank failures from time to time. But if you start to get even larger bank failures or a whole nother wave of multiple medium-sized or large bank failures, that would be kind of their line in the sand. So I think at the current time, it looks more like a profitability challenge than a liquidity challenge, in the sense that deposit rates are still creeping up, and they can only refinance their existing assets, which are their earning interest assets, so quickly. So I think the risk for banks now is that they probably are going to have to reduce share buybacks, slow or pause dividend growth, and try to build capital, right? So that's kind of the base case, is more of a profitability challenge than a liquidity challenge. But if the Fed gets aggressive again, or if there's some sort of unexpected catalyst, I don't think we're out of the woods yet for risks of further liquidity crisis. So I wouldn't say I'm confident that the banking system is settled, even though I think maybe the rate of change, the speed of some of this is behind us, but it's still fragile equilibrium. So I think ones that are under the FDIC limit, we're not seeing a lot of deposit flight. We've also seen data from some of the biggest regionals, like the super regional banks, and they're not showing signs of deposit flight, even though they're some of the ones that have pretty significant unrealized losses on their securities books. And so I think we're seeing a slowing down of this deposit flight.
Okay.
And the question is, does the Fed want to risk causing potentially another round? If they were to surprise the markets with more rate hikes, and some of these deposit rates go up more quickly, that could be a catalyst for a whole nother round of bank failures and deposit flight. So I think I think they're signaling with what Powell said, that they do want to now pause, or at least very cautiously move forward with tightening. And I think if they stick to that, they have at least a decent chance of causing still a bank profitability challenge, but maybe no longer a bank liquidity challenge, which is a worse challenge. So I do think that's a risk. I think it's a bigger risk for the shadow banking sector. That's where they have a lot of the direct I think that's largely going to come down to Fed decisions. I think, unlike the 2008 crisis, because that was a solvency crisis, that there's not much the Fed could do once it started to happen. It was basically a fiscal decision. Because this is mostly a duration problem, an interest rate matching problem, the Fed at any time can determine whether or not banks keep failing or not. If they want to cut by 200 basis points, for example, they drastically reduce the chance of more bank failures, but they would risk letting inflation run hot. If they want to kind of focus 100% on controlling inflation, then they are likely to more likely to lead to bank failures. So I think with their current signaling of signaling that they're going to pause, they're starting to reduce the chance of more bank failures. But I still think we're in this kind of equilibrium zone where a handful of people can basically determine whether or not we have higher inflation than expected or higher bank failures than expected. I think one of those two is probably going to surprise to the upside.